But with a slight gain, the Dow did notch another record high. Joining us now is Liz Ann Sonders, Charles Schwab, Chief Investment Strategist. Liz Ann, always good to have you on the show. And let's start right there, Liz Ann. Nvidia earnings after the bell tomorrow. So in focus here for investors, Liz Ann. As a strategist, how are you thinking about that print? What it means for the market, the index, and that AI trade?
Well, obviously, it's the poster child for AI, and I think it's increasingly important, even though it is only one company, because one of the themes throughout, second quarter earnings season around AI that contributed to the pullback that we saw in technology in the Magnificent Seven was maybe a timing disconnect between the CapEx associated with AI and the investments needing to be made versus the revenue generation associated from it. I don't think all of those unanswered questions get answered after 4 o'clock tomorrow, but you might start to fill in some of the blanks given what Nvidia is going to say, especially as it relates to their outlook.
Liz Ann, how much of the market's momentum, when we try to figure out, I mean, obviously we're part of the media, we're making a big deal about Nvidia's results, but it's just one piece of the puzzle, right? So you talk about everything else that's at play right now, the fact that we have seen some of this broadening play out, a lot of that on the back of some of this expectation when it comes to rate cuts. How are you factoring that in? Just how much of this excitement has already been priced in at this point? And if not, maybe what that upside could potentially look like?
Yeah, so I think we're at an interesting point as it relates to prospective Fed policy. Obviously, the market is now pricing in an assumption that the Fed starts to move and starts to cut rates in September. Our base case is that they'll start with 25 basis points, not 50 basis points. And to those investors out there that are gunning for or hoping for an aggressive Fed to the tune of, starting at 50 basis points or having multiple 50 basis point moves, I'd say be careful what you wish for, because if you look at all historical rate cutting cycles, there is a pretty meaningful difference between what the market does, particularly if you measure it via things like maximum drawdown, when the Fed is moving aggressively versus the Fed moving more slowly. Typically, if they're moving aggressively, they're combating a recession or a financial crisis or some combination thereof. So you actually want to be cheering for a Fed that has its eye on the escalator on the way down, not the elevator on the way down. I think that's the most important thing that's in focus right now.
Liz Ann, we had another strategist on the show today who said, in his opinion, Jay Powell should have already started cutting, over the summer. What do you make of that opinion?
The Fed is data dependent. You could argue that the data was not suggesting that. You had started to see some cracks in the labor market. And I think an assumption about the Fed, and by the way, it's a counterfactual. We can play armchair quarterback all we want, and it would have been better had the Fed moved in July. There's no real answer to that. That's the ultimate counterfactual. But the inflation data, even at this point, doesn't yet suggest the need for the Fed to move aggressively, to have moved in July, which at the time would have been going against what, in essence, they had been telegraphing. So I think it probably makes sense for them to start in September. And as I said, we're penciling in 25 basis points because you don't have core PCE at the Fed's target yet. Although you have cracks in the labor market, it's not a severe dislocation to suggest that the Fed has gotten significantly behind the curve.
Listen, there's lots of focus, you mentioned the labor market right there, and obviously surrounding the weakness, especially on the heels of that latest print. But the softening, though, is it just more so the fact that you're characterizing this, or the characterization should be that it's coming into better balance rather than any sort of significant downside risk at this point?
I think it is. It is coming into better balance. We've seen a lot of that tightness in the labor market get eased. And Powell did mention at Jackson Hole that the weakness that we have seen in the labor market is pretty much all they want to see, and they want to prevent further weakness. The problem is that once the unemployment rate inflects, it tends to continue to go. It doesn't tend to bounce around at a low level, and they're mindful of that. I don't think inflation is yet in the rear view mirror for the Fed. Maybe it's moved from through the windshield to the side view mirror, where the labor market data is more in the windshield. But clearly, we're in an environment now where you want to focus on both sides of the Fed's dual mandate. That was obviously not the case when the Fed was in the tightening part of their cycle, where they were solely making moves off the inflation data.
Liz Ann, back to the market. I'm curious, after this rebound we've seen here, your take on valuation and sentiment.
Valuation is marginally better thanks to the pullback. We did see a little bit of an easing in some of those mega cap names, but we're still in the high 20s for the Magnificent Seven. So you are at that point, especially given we've seen some deterioration in third quarter consensus estimates relative to second quarter, that we are a bit in that show me environment because of valuation expansion that predated this recent pullback. Outside of the Magnificent Seven, you're in the mid to high teens, a bit more reasonable in terms of valuations. And I think that's one of the reasons why we've seen this broadening out. If you go back the past year, only 11% of the S&P's constituents have outperformed the index itself. Over the past months, it's 65% of constituents. And I think that to some degree is this idea that there is value to be found outside of that small subset of prior leadership names.
And Liz, more specifically, just sector-wise or some of the trends that you're watching, where else are you finding that value? Clearly, there has been a lot of excitement play out in the market outside of tech.
Yeah, we think leadership has been and will continue to be more consistent at the factor level or characteristic level. And we've been suggesting staying up in quality in terms of factors. So factors in focus for us would be profitability, strong free cash flow, strength of balance sheet, high interest coverage, but also bringing in those value components, almost like what we used to talk about a lot as being a GARP approach, growth at a reasonable price. So we think you're better served taking more of a factor approach and applying that factor analysis, that factor screening across the spectrum of cap indexes and across the spectrum of sectors versus the more monolithic call that comes with trying to make a sector decision.
Liz Ann, we are always lucky to have you on the show. Thanks for joining us.
Thank you very much. My pleasure.